Welcome to Market Movers. I'm Jim Uriel with Scott and Mark.
Hi, Jim.
Okay, so we are a week away from an FOMC meeting where the market says 99% chance no move, and the CME Fed, I did that for drama, and the CME FedWatch tool says the next move is more likely an ease. Is the market ahead of itself?
I'm not so sure the market's ahead of itself, other than the fact that maybe the whole Fed is ahead of itself, in the sense that now, not only in play, Jim, do we have the U.S. Fed, global central bank coordination is back on the table, Brexit, all these things that seemingly are pushing rates down globally.
Okay, here, specifically, if the China trade deal gets settled, will all of a sudden the market change its expectations for the Fed and start pricing hikes back in?
I don't believe so yet, because of the fact that it still needs to show up in the data. And we've been working on this China trade deal for, years now, it feels like.
It does.
So it needs to show up in data points before the Fed's going to act.
Okay, now before we dive into our trade discussion, I'd like to point out these are trade examples, not recommendations or advice. Scott.
Yes, Jim. Wow, that was quick.
Yeah.
My goodness, I got to get ready for those, Jim. You know, it's funny talking about rates and just talking about that global central bank fervor that's out there to seemingly push rates down and promote growth out there. I just believe that a lot is already in the market as far as the ZN. I believe that the bid is already in ZN. So today, Jim, I'm looking at maybe an example that might be able to hedge us a little bit with respect to that view. So specifically looking at buying the week 5, 122 half, 122 put spread for about 8 ticks. This trade expires March 29th. It risks 125 to make potential 375. The underlying, like you mentioned, is 122, spot 24. Just because I think if there's any sense of any inflationary data coming out, maybe stronger economic growth, anything that's maybe going to put a little sell into the ZN, that's a nice expression for me to have an advantage there.
From a medium-term technical standpoint, I kind of like this trade. I'm going to go opposite of it, but we are kind of at the top of a channel that's been there. I personally think we're going to break out to the upside. And I put the reason I'm saying this is because we've rallied the stocks 22% since December 24th. It's a massive risk-on environment, and at the same time, rates keep going lower, prices keep going higher. So I'm looking at the call spread. The week 5, the same as you, the 122 and 3/4, 123 and 1/4 call spread for 12 ticks. Expires March 29th, just like yours. Risks 187 to make a potential 313. Now 122 3/4, that lower strike, like you said, the market's trading 122.24, which is the same thing. That's what 3/4 is. So your put spread is a little lower than where the market is. Mine is right at where the market is. Thoughts?
Well, I don't like the direction, clearly,
how about
because
risk
I
reward?
believe that data or that expectation is out there already. But commenting on mine, Jim, I don't need a terrible pullback, let's say, in the ZN for my put spread to fill out either necessarily. Just kind of this maybe working off of some of this fervor of, hey, rates are going to keep going lower, central banks are going to keep stimulating, growth is going to stay weak. It just feels like this story at some point has to come to an end.
Understood. Thanks for joining us on Market Movers. I'm Jim Uriel, where we're helping to make you a better trader.